Welcome everyone to optimizing your Social Security benefits and the strategies to effectively do that. My name is Jim Nowak. I will be your presenter today for the next 15 to 20 minutes that we have allowed. We are going to get right into the material. I hope that you get a lot of value out of this. If you have questions, you may use your hand function and we'll look at that at 15 to 20 minutes into the presentation. You could also use the chat function. So again, thank you very much. Let's get into it right away. So first, okay, my clicker, let's make sure it's working. There we go. Okay, so here I'm going to ask you, in life, would you rather be somebody who is early or delayed? And would you rather pay a penalty or get a bonus? So these are questions I'm going to address a little bit later, but as we get into this presentation, I want you to think of that. So what we're going to address today is the problem. The problem that we're going to talk about is that people are making really poor decisions, really terrible decisions that can be very costly when it comes to their Social Security. If you think about it, your parents or maybe your grandparents, there's a very simple option. At 65, when Medicare was available at 65 and so was Social Security, I just elected. And maybe they claimed a few years early at 62. But as you know, most of you are probably baby boomer generation, we're thinking that the strategies are much more complex. Retirement is much more complicated and potentially a lot longer. And then also you have a lot more of the burden on your shoulders. You don't have the benefits more often than not of that pension. Maybe some of you do. And I also mentioned, why is an advisor here talking about Social Security? It's because truly I work in the retirement planning specialty, and it is a huge component of your retirement. And I think there's a lot of information that people are just not getting, and that's part of why I'm here. And I promise you, you're going to get everything that you are hoping for, was pure education, no sales pitch or anything of that sort. So what should we know about Social Security? So first of all, you got to think about there's a lot of claiming options. They've done studies where a married couple may have up to or over 22,000 claiming strategies. Holy cow, that's a lot. You got to think about that your decisions are not just for you. It's also if you have a long life, a short life, if you have a spouse, if one of you are predeceased each other. So there's a lot of consequences. It's not a Ponzi scheme. It's not going to go bankrupt. And I know that a lot of your family and friends have had good experiences with Social Security, but that doesn't necessarily make them an expert in your situation. So what do you want to know? Is it going to be there? And how am I going to get benefits? How should I make claim? And how do I maximize it? And also maybe minimize taxes along the road. So that's what we're going to cover. So let's get into a little bit about the basics of Social Security and what the value is. Let's really talk about it. But again, the elephant in the room, is it going to go bankrupt? I had a whole bunch of slides, but we certainly don't have time to go down that avenue. But I will tell you that the last projection of the trustees of the Social Security Board is 2034 is when the fund will be depleted. That means we're just going hand to fist, meaning the money from the workers is coming right to those that are on claim. So there is still money in the system, but the percentage that are thrown around is about 75 to 80% of the benefits might be available. Let me just assure you, think about this. Picture if one day the Social Security Board said, tomorrow we're going to cut benefits by 80%, because our government likes to make decisions at the last minute. That's probably what might happen. But AARP would have a line of cars all across the country heading to DC, and you wouldn't get past Richmond from Raleigh. So I don't think boomers have an issue to worry about. We've got to be mindful, but there are ways to change this. They could raise the Social Security age for me. I'm 44. Maybe I have enough planning. Certainly my children. They could raise the tax threshold that they tax more. And there could be other adjustments, maybe even cost of living adjustments might be adjusted. That's what we'll refer to as a COLA. But at the end of the day, I don't think baby boomers should have to worry about it. You're right there. I don't think there's going to be big changes. So let's talk about how do we make Social Security clearer to you. So we're going to have 4 insights we're going to talk about. Number 1, it's inflation-protected income. Inflation-protected income. And I'm going to tell you, inflation kills purchasing power, and that is fertile in retirement. Because if all the goods stay the same and they didn't go up in price, it would be a lot easier to handle retirement. So let's just take a look at this. So if you could zoom in here and you see this, if you were to claim available tomorrow, $2,000 a month in Social Security benefits, and you live 10 years, you'd have about almost $300,000 of benefits that you received. If you lived in retirement claiming for 20 years, it'd be over $600,000. And if you had a 30-year retirement, which, let's think about it, claiming at 67, 97, okay, maybe some of you are going to get there. There's a high chance most of you are going to live into your 90s. Okay, so you're over $1 million in benefits. But wait, cost of living adjustments, inflation protected income makes the case much different. Look at those numbers. In 10 years, that $2,000 check you're receiving will be worth about $2,585 or almost $2,600 a month because it ratchets up with inflation. In 20 years, it'll be 33, and in 30 years, nearly or over $4,300. So can we depend on this, right? And how much are you going to get as a benefit? Well, it depends on how long you've worked. It's really the average of your 35 highest income years. So it might have a bigger benefit or a bigger move to somebody who's only been in the workforce 25 years. They really have to continue in that Social Security. And those of you who are in your highest income years, retiring early might be a possibility because you have a lot of the benefits already into the Social Security system. Number two, insight number two. Well, it sounds good, but why shouldn't I claim at 62, versus delaying to age 70, right? I want money in the system in case I don't make it a long time. Well, let's just talk about what that is. So when that leads into your decision making, it comes down to when should I apply for benefits? Critical question all of you should be asking yourselves and finding a real answer to. So let's just look at this. There is a penalty associated with claiming early. If you were born 1960 or later, you have to retire. Your full retirement age is 67. If you were born between 1955 to 19, it's going to gradually get you closer. You might see 66 in 2 months, 66 in 6 months, etc. But let's just look at the right chart. For anybody that was born 1960 or after, if you claim at 62, you're going to get a 30% penalty. You're only going to get 70% of the benefits that you would have had if you claimed at 67. And there's the penalty chart, if you will. Okay, but you also know that you might get a bonus. Doesn't everybody like the idea of getting a bonus? Every year you defer, you get an 8% raise on your Social Security check. So again, if we look at the right column for those full retirement, age 67, 68, you're going to get 108% of what your full retirement age benefit would be. Then it's 167, that's 124. So depending on when you were born, you can get anywhere from a 24 to a 30% increase in your retirement income every year, guaranteed by the Social Security trustees. So let's kind of just look at that check. Okay, I'm going through these numbers quickly, but I want to give you a gauge. Let's look in the middle, the third column, age 67. This is a person, $2,800 is their benefit at age 67, their full retirement benefit. Okay, so third column towards the bottom. But if they claim at 62, they're only going to get $1,960 per month, not $2,800. But if they waited to age 70, it's up to $3,400. Big, big difference. And then if you add COLAs, that right chart, that inflation adjustment, it ranges from $1,960 to $3,183 to $4,300. It makes a big difference. So that's why you should consider maybe delaying some or one of your benefits if you're a married couple. So let's talk about how do we maximize it, right? We talked about strategies. So let's really get into that. So one, you can work a little longer. If you go back to 1972 and you made $1,200 and you're making $150,000 this year, having those higher income earner years, even if you're making $50,000 now, having a couple more years on your records, replacing that $1,200 way back long ago for 50 grand or 130 grand will move the needle. Your Social Security estimates are all based on what you made last year, projecting it into the future. Look at that 4-page statement, ssa.gov. You could open up an account, see your statement if you're not getting it mailed to you. But you also want to make sure it's accurate. Make sure you have no zeros in there or missed numbers. but definitely working longer can improve your claim and your benefit. When to claim, I already talked about that. Full retirement age should be the starting point for almost everybody on this call. Early retirement may be for health reasons or life expectancy, etc. But full retirement to age 70 is where you should be looking. But you also got to think about your spouse. Okay. Oh, by the way, how do we benefit? Also, we got to factor in it is taxable. If you make more than $44,000 as a married couple filing jointly, they will tax almost all of that Social Security. It means it will be included as taxable income, and you might be paying 12% or 22% to the federal government, and that's something to be aware of. Okay, you've got to look at this, and you got to plan on it. So how do we minimize taxes, right? Because minimizing taxes means more money in your pocket, of course. So you can maybe think about making sure their investments are tax smart, being very tax efficient with your investments. Municipal bonds don't count. They actually get included. Even though they're tax-free income, they affect your Social Security. RMDs, the required minimum distributions, you need to take that money out by age 72 now. Some of the older folks started to claim at age 70 and a half. But when those forced distributions are coming out of your 40 somethings, your 401, your 403B, your IRA, it's going to be added to your income. So you got to be mindful of that. Maybe you think about Roth conversions or taking money out of that account early and allow yourself to delay Social Security. Doesn't mean you can't retire just because you can't claim Social Security. Maybe you live off your 401k for a few years while your Social Security benefit grows. And then, of course, delaying, reducing expenses, and making sure, again, you're being smart with your IRAs. These are ways to minimize your taxes. So the key points to remember here is that if you retire early and you claim early, it's going to be lower from the beginning and it'll stay lower. Cost of livings compound that. It's not an Excel spreadsheet. You just don't do a very simple calculation. There's complexity with Social Security. I'm going to keep moving. Number 3, am I going to go? I'm not going to live so long, so why should I not just claim right now? Well, you got to think about it. It's not just you, it's also your spouse we got to think about. So let's talk about spousal benefits. If John's primary insurance amount, or PIA, his benefit at full retirement is $2,000, and Jane only gets $800, Jane can actually take a spousal benefit that's half of John's. Half of John's is $1,000. It's greater than hers. So at full retirement, she can actually claim a spousal benefit. That's a way to maximize your Social Security. Look at the spousal benefits. Coordinate spousal benefits. Okay. Here, I'm going to give you the 2 biggest strategies we use in my professional life on how to maximize Social Security benefits. Number 1, the maximization strategy. If the lower earner, their Social Security benefit is more than half of the higher earner. So let's just use that example. John was at 2,000 and Jane was at 800. Let's just say Jane was at $1,500 a month. Her benefit is more than half of John's. And that, again, rule of thumb, don't always apply to everybody, but the best strategy to make the most of Social Security is for both of them to defer and claim at age 70. That is how they will maximize the lifetime benefits over an average lifetime, not just long. Remember, a lot of people are longer than averages. I think most of you are probably above average. Your life expectancy goes up every day you're living because you made it through your 0 to 5. You made it through the 20s, and you've made it the last decade or so where there's a lot of bad things happening to some of the people you know. So that's the maximization strategy. Now, what about that example? John's is at 2,000 and Jane's is at 800. Her benefit is less than half of the higher wage earner. Okay, it could be man, woman, woman, man, doesn't matter. But her in that strategy is called a hybrid strategy. 70 and 70 probably still works as the maximum. But if she decided to claim at full retirement age and maybe even some other considerations, getting income now while John's ratchets up could be a way to get money now and also make sure that strategy is almost as good. It can be almost as good, and that might be helpful. So you might want to take a look at that. That's the other rules of thumb to consider. And then what about widowed or spousal benefits, divorced? So I'm going to just get right to it. There's 2 critical factors. If you are a widow or a widower, you can claim benefits off of your deceased spouse. Okay, and it's something to consider. You might be able to claim as early as 60 or 50 if disabled, but you might get anywhere from 80 to 100% of their primary insurance amount. We just talked to somebody and they were thinking about claiming their own, and they realized their spouse, that benefit was like 400 less than hers. She's going to claim that and then claim hers at age 70. Okay, and there are a lot of rules with this. You got to talk to somebody, but also I'm going to mention let's see, there's some rules there. You got to have been age 60. You had to have been married at least 9 months. So there are some rules here. But then divorced folks, you have to married at least 10 years. That's a magic number, okay? If you had been married for at least 10 years and your ex-spouse is at least 62 and you've been divorced 2 years or longer, you can actually claim on their benefit. It doesn't even affect them. You know, your ex-spouse might have had 4 marriages that lasted 10 years. You could have 4 people claiming off that ex-spouse. And it doesn't affect them, and it's just a benefit of yours. So you need to look into this, and you got to be careful. Social Security office, really great, helpful folks, but they don't know all the claiming strategies. They're just looking at which is the biggest check now. They don't think about the more complicated strategies. So I'm going to wrap up here fast, but man, at the end of the day, geez, this is more complicated than I thought, right? So let's go back to our question. Would you rather be early or delayed? And would you rather have a penalty or bonus? There's something called behavioral finance. It's like a psychology of financial planning. Great study if you want to be smarter about investments. Great place to read. But it's all about how you question. Nobody wants a penalty, right? They want a bonus. And nobody wants to be delayed. They want early or delayed, right? So at the end of the day, I think these are really serious decisions that are long-lasting. You get one do-over in 12 months. After that, you're locked in. And again, the key is, I want to mention that if somebody dies in your family, there's 2 of you, the surviving spouse gets the larger check. So by that one higher wage earner deferring to age 70, it's sort of like a built-in additional retirement income protection. So the problem, bad mistakes, the key insights we talked about, inflation-protected income. Your monthly benefit will reduce forever if you make the bad decision. Couples should always maximize the higher earner's benefit. And if you're widowed or divorced, you should look into the strategies that are available to you because they're not very clear. Nobody's just going to let you know that. And then the solution is, regardless of who you work with or on your own, you need to align Social Security claiming with your retirement benefit plan to make sure that you have the best strategy. And you should consider IRAs, Roth conversions, if you're going to continue to work, what's your investments all along with this. So it's too important for guesswork. I will throw out that we will offer for this class, if anybody wants just a free Social Security analysis, we'll do that as a benefit. There's our information there. But at the end of the day, I'm going to turn it over to questions at this point. Okay, so I'm coming back. Raise your virtual hand if you have a question, and we've got a couple minutes to get hopefully a few questions answered. Okay, Daniel. Oh, your name sounds familiar.
Hey, yeah. Jim, I took your class a couple of weeks ago, retirement planning today. I thought your office was going to contact me, but they never did. So
check your Wake Tech email. Check your Wake Tech email, and we'll follow up, Dan.
Okay, thanks.
What do you have? Do you have a question about Social Security?
No, this is the second time I've covered it in a few weeks, so I'm much more savvy about Social Security than I was previously. Thanks.
Awesome. So you'll learn something from our class. Fantastic, Dan. Thanks so much. We'll talk to you soon. Any other questions? Dan, if you put down your hand, we've got Faith. Faith, if you want to unmute and ask your question.
So, yeah, I am 60. I'll be 63 in a couple of months. My husband has retired and is collecting Social Security. So you're telling me that possibly I should wait until I'm 70? That means I've got to work 7 more years to get a good return on the Social Security? Or is there, depending on a situation, can I stop working earlier? That's my goal, is not to work anymore.
Isn't that all of our goals, right? Or at least it's work optional, because that makes all the difference in the world. So let me mention this. Faith, very important for everybody to understand. To defer Social Security doesn't mean you have to retire later. That's the importance of having investments and other things. So you can defer Social Security for a period of time, get a guaranteed raise on your income, and maybe use your investments on the earlier end to help you bridge into Social Security later. Because proven mathematically that if you have a long average or long life expectancy, having a bigger retirement check like Social Security will keep you safer. I mean, it just, the chance of running out of money goes down. So Faith, I would say it's always complicated, but one, you should at least start at your full retirement age and look at that, because if you claim at 63, you're looking, depending on your date of birth, you're looking at a penalty of probably, 20 to 25%. Versus if you could bridge until at least full retirement age, which may be 66 to 67 for you, and you want to look at that. I will also mention, if anybody's been born before 1954, there's some other really complicated but very beneficial claiming strategies. If you have a birthday before 1954, that's something to investigate. But Faith, this is where you have to look at it in your whole retirement plan, right? So maybe you and your husband can live off investments while your Social Security ratchets up. 70 is the ideal, the most income. And you also have to think about, did your husband claim at full retirement age?
No,
Okay.
he was
So
62.
okay. So remember, if one of you predeceases the other, the surviving spouse gets to pick the biggest of the checks. So if you were to defer, it could be sort of an extra, insurance for your retirement for either one of you. But you gotta do the math, and you gotta have a Social Security analysis so you can actually see it in black and white and look at the numbers. And I'm going to tell you, these numbers make tens and hundreds of thousands of dollars of difference depending on how you claim. These are big deals.
Thank you.
You're welcome. Gladys, do we have time for another question, Carolyn? I'm getting you.
Yes. I am already retired and I'm receiving the benefits of Social Security, but I would like to know, what should I do? I was divorced on 2018. What should I do in order to find out if I am entitled to have some benefits from my ex-husband's Social Security?
Okay. There are some rules about when you can claim, but the easiest to find out is if you're eligible. One, were you married more than 10 years?
Yes.
Okay. So that's the magic number, 10 years of marriage. So you are, it is an option to look at. It may not be as good as yours, right? Because you get half of your spouse's income. That's a spousal benefit, or a divorce benefit is half of your spouse. But you can call the Social Security office. You need their Social Security and their date of birth. Whether they might be able to pull it up from other information. They might need a marriage certificate to officially give you the information. But I think there's a way they could see that it's been linked, and you call up the office. A little hint here, you call up and you reserve maybe someplace in Sanford. Their office is a little bit slower than the Raleigh office, and you usually get a phone call or an appointment pretty quickly that way. So call the Social Security office, ssa.gov. You get a lot of information on that website.
And what about in case he got married again? Do I still?
Doesn't matter to you.
Oh, it doesn't matter. Okay.
That's right. Doesn't affect you, and it doesn't affect him. Whether you care or not, it won't affect his benefits. These are your benefits and what you're eligible. Okay?
All right. Thank you.
Go ahead and call them. You're welcome. 15 or 20 minutes goes by way too quick, but I hope we covered a lot of information. Again, feel free to reach out to us if you want an analysis, if you have any questions. And also look up our retirement class we'll be doing hopefully in the spring, retirement planning today. Mike and the team at Lifelong Learning does a great job of a lot of great information. If you want to learn more about this, there's a lot of great classes through Wake Tech's Lifelong Learning Center. Is that all my time, Carolyn, or do we have any other questions? Okay, I think she's giving me the axe or the hook.